Do you remember the day that someone told you that Santa Claus doesn't exist? That the whole Christmas story is just a fairy tale? And that all those gifts you received during all those years were given by your parents? Well, this is exactly what Felix is trying to do with dividend investors in his new video, The Irrelevance of Dividends. He's trying to debunk the dividend growth investing myth, and today I'm going to debunk his video. But first, let's roll the intro. Dividend investors, bonjour, this is Mike Leroux, founder of Dividend Stocks and passionate investor. So today we're going to talk about the irrelevance, or should I say, the relevance of dividends in an investing strategy. And obviously this is an answer to Ben's video. And Ben, if you're listening to this video, please do not take it as a personal attack. In fact, it's just that I think that your nose is a little bit too close to your financial books. Because you're bringing a lot of good things on this video YouTube that you have, but some others, I don't know, like dividend growth investing being irrelevant. And I know you're gonna tell me, Mike, you just don't understand the fundamental of financial theory. Your comprehension is so far behind that I would need Sesame Street's Muppet to explain it to you. But that's the way it is, right? In your video, you're telling me that if my investment return are good, then it's because of luck. Because we all know that luck is based on financial theory, right? Or like it's a scientific force applied on all universe. So when you're succeeding at something, it must be luck. The rest is just numbers and science. So now, let's get back to academic studies, right? In the introduction of your video, you mentioned Modigliani Miller. I must admit, you bring such an important brain power to your theory. I mean, those guys are not only finance teachers, they not only like reinvented the old financial theory writing books, but he also won a Nobel Prize. So I guess it looks very good on the resume. According to Modigliani, man, that's a hard word to say, Modigliani Miller, an investor should be indifferent between company A paying $1 in dividend every quarter and company B not paying a dividend at all. That totally makes sense. I agree with that because money is not being created by some kind of magic or some kind of luck, get it? Actually, if a company is paying $1 in dividend, its balance sheet, its value drops by the same dollar. The other company keeping that dollar in his pocket will likely do something with it that the company A doesn't do. So basically, the investor has a choice of either receiving $1 in dividend and keeping his shares, or just keeping his shares and having a company that worth more. So in the end, he's completely indifferent between the two. And that's totally makes sense. Now, that's not the point. That's not the point of dividend growth investing. And I think this is where you just don't get it. A dividend growth policy is an indicator, a very strong indicator that the company that you're looking at is a strong business. And strong businesses tend to make profit. And when you tend to make profit and grow that profit, well, your shares tend to go higher than your peers, right? That just total common sense. So picture this. You have the possibility of selecting a company that you usually say that they're exposed to favorable factors such as a leader in the market, showing some very strong growth vector, robust cash flow, healthy balance sheet, paying coffee to their employee so they get more productive. All those things. Why would you not select those companies? And because I know you like academic studies and research, let's pull out some. The first one I've found is quite interesting because it's coming from Vanguard. And Vanguards are, selling ETFs. And they kind of like put the paper together with all those graphs and stuff, telling you that dividend isn't that great, but at the same time, they have to show you this graph. And this graph is telling you that over that 10 years period that they've looked at between January 1997, and 2016, the stock market did worse than dividend growers. And dividend growers not only outperformed the global equity market, but also showed less volatility. So let that sink in a little bit. You have the possibility to select an investment strategy that will allow you, number one, to outperform the market, and number two, to have less volatility. I mean, it kind of sounds like a win-win situation for me. As an investor, if I have an investment strategy that will likely outperform the market and provide me with less stress on a day-to-day, on a quarterly basis, it's kind of like the perfect strategy to achieve my goal. And I'm just going to put a small parenthesis here. The best investment strategy isn't dividend growth investing. It's not index fund. It's not writing call options or trading penny stocks or invest in Bitcoins. The best investment strategy for you is the one that will help you sleep well at night. Not me, not Ben, not the other guy, the financial advisor, whatever, you. So if you're feeling comfortable with your investment strategy, you already found something. You're already a winner in this battle. Now, back to mine, which is dividend growth investing matters. So Vanguard's kind of fun, but just only tells a story about 10 years. Not that much. It's what Ben would say, an anecdote. Fair enough. Now, let's go back to my favorite one, Ned Davis. So now, when you look at this graph, you're going to show like the most popular graph among dividend believers. This graph tells you how dividend growers from the 70s up to today as crushing everybody. Crushing the market, crushing non-dividend payers, crushing dividend payers, just like dividend growers is the key. And now, kind of funny because I wrote another paper telling me, Mike, you're completely wrong. You don't know anything about anything. Meb Faber, another brilliant mind, wrote tons of books, run portfolio managing or mutual funds, I don't know, like Cambridge or something like that, whatever. Guy's a smart, right? Has a bunch of title. And he wrote the dividend growth myth. And don't worry, all those things are like right down below, all the links, all the notes. Don't worry, you can dig that for yourself and enjoy like hours of reading if you want. So basically what Meb Faber says is Ned Davis research are wrong because they use geometric indexes. And now we should use arithmetic weighted dividend charts. Back then, back in the 70s, and when they were doing those studies, a lot of like the whole industry basically was going with geometric means, and they all switched over recently to arithmetic. And I'm not going to make the difference, and I'm not going to go deeper in that, but first I'm just going to pull out a point very important here is sometimes academic studies, no matter who are doing it, are using methodologies that in the future may evolve or may end up being wrong. So keep that in mind when you're reading studies, because sometimes the world evolves. And this is why the theory is not always good, and it's not always the fundamental of everything. So basically, that's the first thing. But the second thing is even most important is even if Ned Davis did the whole research back using arithmetic means, they still get to the same point. Dividend growers outperform the market. Like the difference wasn't that staggering. We're talking about 0.54 out of like 40 years, out of like 46 years, but still 0.54 over 46 years is strong enough to tell me that basically dividend growth investing works. And it works because it shows you the exposure of those companies to favorable factor. So now let me get to an easy analogy so you can understand. It's apple season right now. You have the choice of picking your apples from basket A. Basket A has been filled with hand-picked apples the very morning that you're entering the store. And they were picked from a bio high-class orchard, like the best place ever you can pick your apples. And now you're going to pick your apples from that basket. Or you have a second choice, going to the grocery store and just picking apples randomly. You know, it could be coming from like the worst place ever with pesticides and all chemicals and stuff like that. There could be rotten, and they could be also amazing, trading at a very low price for no reason. So you're just picking up apples from that rack. And if you don't know what you're doing, absolutely don't know, you have no clue how to pick up apples, you decide to go to that grocery store and you just buy the whole rack of apples, regardless what happens. Did you recognize yourself, index investor? Yeah, that was talking about you. So back to my example. If I'm to pick apples somewhere, I might as well pick it from basket A, which has the best apple ever. It doesn't mean that I'm not going to find a worm in one of those apples and it's all going to be amazing apples. But in the end, my chances are very good of me picking strong apples or company. Or am I talking about dividend growth right now? Yeah, there you got it. So basically that's the whole purpose of selecting dividend growth as your core strategy. Now you're gonna bring a bunch of other academic studies telling me that I, as an individual stock picker, a small investor, and basically almost in my basement, cannot beat the market. I'm not a genius, right? And I have no psychic powers to foresee the futures and determine which company will beat the market. And you're totally right. And when you pull out those studies, they're going to tell you that professional investors, like basically portfolio managers, can't beat the market. Like 95% of them over 5 or 10% a year will fail to beat their index. And that totally makes sense. The first reason is fees. Obviously, if you run a mutual fund company and you have to charge 1%, 1.5%, or 2% fees, you're already way behind anybody that is doing index investing or just looking at the market, right? So fees is a big way to overcome. And then you also have the problem of size. If I, as an investor, I want to put 5% of my portfolio in Microsoft, nobody's gonna ever notice. But if I run a $500 million fund and I want to put 5% of that in Microsoft, I cannot do it in an intraday trade. It's not going to work, right? It's going to create a panic or an overall hype around the stock. And we don't want that. So basically, portfolio managers cannot exactly move the money as they want. And as they grow, as they're doing a good job and they're getting popular, more money comes in. And if more money comes in, it gets a little bit more difficult to manage. I don't have that problem as an individual investor. And the third one is they are human being. Damn, I'm a human being too. But the point is the portfolio manager must bring results every quarter, every year. He is always looking at his benchmark because his boss, other investors, pretty much the whole industry is looking at him performing quarter to quarter. So if you fail for 2-3 quarters in a row, man, your job is on the line. And that will come play in your brain. I don't have that. I don't have to be always performing. Some years I'm not having a good one and it's okay. I don't mind. I have a clear strategy and I keep focusing on it so I don't have to make trades or changes just to please someone. And remember what happened in 2008? Lots of portfolio managers, they just put aside their strategy and trying to focus to minimize their loss. Just to say, oh, I was cash first, so I'm losing a little bit less money than others, so I should keep my job, pretty please. And those are the reasons why portfolio managers are not doing a so great job compared to individual investors that will stick to their strategy. And then that's a very important part. If you don't have the knowledge, if you don't have the time, and you don't have the interest in managing your own portfolio, index investing is great. But if you want to take care of your own money, because the only person that cares about your money as you do is yourself, well, then maybe you should consider another type of strategy. And dividend growth investing is one of them. And it does work. I've proven it with Vanguard study, I've proven it with Ned Faber and Ned Davis. So basically, 3 studies telling me that if I pick dividend growth stocks, my likelihood of performing well in the market are great. And it's not because I'm a genius. It's not because I can foresee the future. That has nothing to do with it. That has to do with a clear strategy, which is focusing on dividend growth stocks with a straightforward process, with very detailed step-by-step methodology to identify your stocks and picking them, and then apply all that with concise information. Because if you don't act with concise information, you keep reading books and studies and all that stuff, well, you're going to be very knowledgeable, but it's not going to be practical. And let me end that with a small story of mine. If you think that the answer is found in books, well, maybe you should try to apply that to your kids. I mean, there are like tons of books, of theories that have been written to raise your children. And funny enough, none of them is completely right. None of them is completely wrong though, but there's always that crazy factor called human that goes into play. And when you're talking about the financial market, it's exactly the same thing. Yes, we are talking about numbers. Yes, we're talking about money. And those decisions should be completely rational. But the market isn't. And don't tell me about the market efficiency thing. I mean, okay, all right. So in 2018, companies worth 20% less out of fluke. And then 6 months later, they all gain back that 20% in value. Like, how's that efficient? How's that rational? Anyway, I mean, the business is the business. They brought out the same numbers, but for some reason, the market started to panic, and then they started to get optimist. And this is how you can enjoy picking stocks. Yeah, picking stocks. I'm a stock picker. It's not because I focus on dividend growth stocks that I'm not a stock picker. I do pick stocks, so by definition, this is what I am. But selecting dividend growth stocks will help you to achieve your goal. That has been proven in the past and it's going to keep happening in the future. So now it's up to you to tell me in the comment, tell me, what do you think about dividend investing? How is it relevant or irrelevant to you in your investment strategy? But in the meantime, stay invested